Gautam Duggad, Head of Research at Motilal Oswal Institutional Equities. Gautam, good morning and welcome to the show. First, let's talk about what's happening in terms of the markets. You have Trump's tariff truce that's actually lifted global markets. You are talking about the FTA that India has signed with the UK, which turns out to be a positive as well, because lots of opportunities that open up. And thirdly is how the earnings season has panned out so far. So three aspects. Let's start with the Trump tariff truce and the UK FTA. How are you reading into both of these?
Good morning. Thanks for having me. So, yeah, I mean, after several headwinds from September to February, March, the market has seen some bit of a breather in terms of some of the news flow which has come in, whether it is on Trump tariffs, be it on UK FTA, which got signed yesterday, or even for that matter, the corporate earnings. So, UK FTA is a very positive step, and I think government will get a lot of confidence from this, and hopefully they will accelerate the bilateral tariff agreement with US also, because that will be a far bigger one. This obviously augurs very well for several of the sectors which you are mentioning, textiles, liquor, some of the other sectors as well will obviously have to dig more and figure out where the bottoms of impact is going to be positive there. But net, in a current scheme of things, two big nations signing a FTA when there are so many trade-related headwinds, it sends a very positive message across the globe. Insofar as tariffs are concerned, there is a truce. We will know in July what exactly how it actually unfolds after the 90-day pause ends. But I think market has kind of digested it well and shrugged off and moved on to the next thing till this actually unfolds in July, I think 7th or 8th July. So we will see what happens then, which are the sectors, which are the countries which are going to get impacted. There will be a lot of to and fro for sure. And India's position, I mean, it's very difficult to foretell right now, but relatively, I would think India's position will be strengthened given our, prioritization of the manufacturing investment that this government has done through various measures like PLI and so many other incentives which have been offered in the last 5-6 years. So fingers crossed on the tariff related measures. Third and most important, and that's the only thing that matters in markets as we've learned over the years, corporate earnings. After three very flattish quarters, the expectations for this quarter, when the preview was released almost a month back, was that this quarter is also going to be very flat. So expectations were very muted. Against that muted expectations, we are seeing a marginal beat. So, yesterday only we published our interim review. About 120 companies have declared their numbers in our coverage universe. So for those 120 companies, we were expecting a profit decline of 2%. The actual number is a growth of 7%. So reasonably good beat, and even accounting for the sharp swing in the OMC profitability thanks to the marketing margins and GRMs being far ahead of estimate. If you exclude those three companies, even then, X of OMC also, the growth is 6% versus expectation of 2. For Nifty also, the numbers are slightly better. For the 27 companies which have released, the growth is 4% versus expectation of 2%. But more importantly, the spread of sectors which are delivering beat or inline expectations kind of numbers is far, far higher. Hardly one or two sectors have missed expectations so far. There's still a lot of companies still to report. 120 have reported, 180 still to go in our coverage universe. But large weight of companies have reported the numbers. For example, the 27 Nifty companies which have declared results, they account for close to 70% of Nifty weight, right? And they set the tone for the rest of the earnings season. Third, the forward estimate revision is very sort of, I would say, stable. If you look at our coverage universe, we have actually seen a marginal 1% upgrade for FY25 numbers, and FY26 and 27 numbers are quite stable. Similarly, for Nifty, we have seen a percent kind of an upgrade in FY25 and half to 1% kind of a downgrade for FY26-27. So not a very material downgrade, I would think. So we are still at 13-14% growth.
Gautam, so this is the interim review, but if you have to look at the forward estimates from here on and the commentary that has come in from these 27 companies, what's the outlook looking like going ahead if you have to look at FY26? And does that mean the valuations with regards to Nifty 50 are reasonable for an investor to start looking at and nibbling in?
Oh, absolutely. They were reasonable even 2 months back. Whenever Nifty has gone to 20p, the market has rebounded, and it has happened twice or thrice. This is not a technical point, but a fundamental point. If you look at 22,300, 500, which I think is the recent lows, give or take 100, 200 points. But broadly at 22,300, 500, Nifty was trading at 20p, which is where market sort of again rebounded. So 20p has become a bit of a floor for the large caps. And right now we're trading close to 20.6, 20.7 because there has been some rollover which has happened for FY26. To address your point, yes, the forward estimates have not seen much change, which is what I was discussing in the earlier answer to your question. Our FY26, FY27 numbers are very stable, around 1155 rupees and 1330 rupees of EPS. Insofar as valuations are concerned, the top 100 stocks or large caps on Nifty 50, they are looking quite reasonable at an aggregate level also. So they are trading in line with their long period averages. However, the mid caps and small caps is where the valuations are still expensive. The mid cap index is trading at 27 times and the small cap index is trading at 22 times, which is where we need bit of a time correction or some consolidation so that earnings can catch up to those valuations. And then eventually the risk reward will become a little more attractive. Right now, the risk reward is most attractive in large caps in our view.
Okay, so if the risk reward is attractive in large caps right now, your quick comment in terms of Operation Sindoor and the impact on markets, taking precedence of what we've seen during Uri and the previous attacks as well, how do you think that the markets are reacting right now? And are you seeing resilience which is sustainable?
So I think sometimes we give too much importance to this topic. Market has become very mature. We are a 5 trillion market cap. This is a very localized conflict with a terrorist nation, which the army is well capable of handling it, and they're doing it. Market is doing its own job. I don't think there will be any more escalation beyond a point. And the way the market has reacted is very, very pleasing. I mean, there is no untoward volatility or wild swings, which we had witnessed 10, 15 years back, maybe. So market is taking it very nicely, I would think that, there is a conflict which the relevant people are addressing. I don't think it has anyways any big impact on the fundamentals that matter because you're talking about a country whose total market cap would be $50 billion maybe. So beyond few days, I think market will again come back to corporate earnings and move on fundamentals and then look at the bigger picture things on macro and forthcoming RBI policy and subsequent to that, the Trump tariffs and how the US-India bilateral trade agreement moves. So this is a very small thing right now in an overall scheme of things and the way our markets are. It's a far bigger market today. 5 trillion market cap is a reasonably big size.
Right, so that's going to be interesting to watch out for from here on as well. Gautam, apart from that, if you see from a markets perspective, which are the sectors which have led to the outperformance in terms of earnings so far, and any individual stocks that you would want to call out that could become good investment bets?
So, like I mentioned, a lot of sectors have delivered numbers ahead of our expectations so far in the earnings season. So, cement, chemicals, for that matter, consumer durable. There has been a broad-based beat in consumer durable. All the 4 or 5 companies in our coverage which reported numbers, they've been better than expectations. It's still early days in the result season for healthcare, but the 3 companies which have posted numbers in our coverage, even they were ahead of expectations. Metals, oil and gas, ahead of expectation. The big sectors like banks and IT and consumer, they were in line. Auto was slightly better than expectations. So net, among the list of 23 or 24 sectors that we cover, I don't see any big sector which has disappointed so far. As regards individual stocks, a lot of our model portfolio stocks have delivered very solid operational performance. The likes of Mahindra and Mahindra, Indian Hotel. Yesterday, BSE posted a fabulous set of numbers. So many of our long-held, high-conviction ideas in our model portfolio across sectors, they are demonstrating very strong resilience. and which is why we are staying put there. We have a big overweight on BFSI, within which a substantially higher overweight on capital market companies, discretionary consumption,
Right.
IT, healthcare. So
Right.
those are sectors where we are positive for some time and continue to stay positive.
Absolutely. So I think these are spaces and segments that one should be watching out for as well. Thank you, Gautam, so much.